Welcome back to the 10th season of Spidell's California Minute podcast. I'm your host, Catherine Zidane, the editorial director at Spidell, and this week we're covering the property tax planning for taxpayers affected by the Los Angeles wildfires. Spidell's post-tax season update and review webinar covers answers to all of the questions that come up during tax season, like upcoming tax legislation, expiring TCJA provisions, and maximizing disaster tax benefits. Get registered at one of our 4 dates in May at caltax.com under webinars. Following the Los Angeles County wildfires, taxpayers who lost a property in the disaster have several options when it comes to selling or staying and rebuilding. Here are some property tax planning considerations that tax professionals and their clients should know to assist them in making this decision. Taxpayers who decide to stay and rebuild can reconstruct the property and retain the adjusted base year value of the damaged or destroyed property if they meet certain requirements. The property has to have been substantially damaged, so more than 50%. The rebuilt property has to be similar to the damaged or destroyed property in size, utility, value, and function. The replacement property construction generally has to be completed within 5 years of the date of destruction. And the taxpayer cannot have transferred the property's base year value to another replacement property. This exclusion for new construction applies to all forms of real property, not just a principal residence. Any portion of the property that is not comparable will not qualify for a new construction exclusion and will be assessed at full market value. Taxpayers who decide that they would rather move than rebuild or move while they rebuild may be able to transfer their property's base year value to a replacement property and retain their damaged or destroyed property's base year value that applied prior to the disaster. The relief available depends on the type of property destroyed, the location of the replacement property, the time it takes to replace the original property, and the value of the replacement property. Under RNTC Section 69, taxpayers generally have 5 years from the date of a governor-declared disaster to purchase or reconstruct a replacement property and transfer their base year value, if the replacement property is located in the same county. They are not required to sell the damaged property to qualify for relief. Section 69 applies to all real property types and manufactured homes. There's no limit on the value of the replacement property, but any value that exceeds 120% of the original property's pre-damaged market value, or any portion that is not similar in function, is assessed at market value. Under RNTC Section 69.3, taxpayers generally have 3 years from the date of a governor-declared disaster to purchase or reconstruct a replacement property and transfer their base year value. The original and replacement properties do not need to be located in the same county, and there are currently 14 counties that allow for these inter-county base year value transfers. Taxpayers are not required to sell the damaged property to qualify for relief. Section 69.3 applies to principal residences only, and relief is only available if the replacement property value does not exceed a specified percentage of the original property's fair market value, depending on when the replacement property is acquired or constructed. Under RNTC Section 69.6, which is the implementing statute for Prop 19, taxpayers generally have 2 years from the date of a governor-declared disaster to purchase or reconstruct a replacement property and transfer their base year value. The original and replacement properties can be in the same or any other California county. Section 69.6 applies to principal residences only, and unlike the other relief provisions, taxpayers have to sell the damaged or destroyed property in order to qualify. Under Section 69.6, any replacement property value that is in excess of the original property's equal or lesser value is added to the original property's base year value. We cover these provisions in much greater detail in the April 2025 issue of Spidell's California Tax Letter, along with a comparison of relief under Section 69 and 69.6, and a list of other important steps to take for taxpayers displaced by the fires. For information on a subscription to this monthly newsletter, go to caltax.com and click Publications. That's all for this week. Join us next time for another episode of Spidell's California Minute.